the monetary system. Many of you will consider this chapter very interesting, and most of it is quite straightforward. It does contain one analytically challenging topic, which is the process of money creation in the banking system. Uh, we'll probably proceed somewhat quickly through most of the chapter, and we'll spend more time on the money creation in the banking system, T accounts, and the money multiplier. Those are probably the three more challenging concepts here. This is really something that you're somewhat familiar with in terms of, hey, you know what money is and you like it. We're just putting a little meat on the bones. So it's not really a technical chapter, it's more of a definitional chapter. So the reading this video and attending lecture are going to be pretty huge. Now, so what is money? Why is it important? Without money, trade would require barter. All right, so barter trade. The exchange of one good or service for another is bartering. Every transaction would require a double coincidence of wants. If you wanted a pound of bacon and you were a tailor, you would have to find someone with a pound of bacon who needed a tailor. That's a double coincidence of wants. Now, that's an unlikely occurrence that two people each have a good that the other wants. Most people would have to spend time searching for others to trade with, which is a huge waste of resources and quite inefficient. This searching is unnecessary with money. Now, money is the set of assets that people regularly use to buy goods and services from other people. Okay? So, again, a double coincidence of wants simply means that two people have to want each other's stuff. Here's an example. I'm an economics professor, but I'm also a consumer too. Suppose I want to go out for a beer. Under a barter system, I would have to search for a bartender that was willing to give me a beer in exchange for a lecture in economics. Good luck, right? As you might imagine, I have to spend a lot of time searching. On the plus side, this would prevent me from, drinking too much, getting a beer gut or something. But thanks to money, I can go directly to my favorite pub, get a cold beer, and the bartender doesn't have to want to, hear my lecture. In fact, he probably would prefer not to. He only has to want my money, and so we trade that way. So it's not a bartering situation. It's a situation where money eases the transaction. There are three functions of money. The first is medium of exchange. An item buyers give, medium of exchange is an item that buyers give to sellers when they want to purchase a good or service. The second function of money is as a unit of account. It's essentially the yardstick people use to post prices and record debts. All right, it's what we measure things by. It's the unit of account. So in addition to being a medium of exchange and a unit of account, another function of money is a store of value. An item people can use to transfer purchasing power from the present to the future. Okay, store of value, an item people can use to transfer purchasing power from the present to the future. You can save money in a bank account as a store of value for future consumption. Now, in review, money is a medium of exchange. That just means that you use money to buy stuff. Money is a unit of account. The price or monetary value of virtually everything is measured in the same unit. In the U.S. is dollars. Okay, or you could substitute a different country's currency if they're located outside the U.S. Imagine how hard it would be to plan your budget or comparison shop if sellers each used their own system of measuring prices. Lastly, money is a store of value. Money holds its value over time, so you don't have to spend it immediately upon receiving it. It's not something that's just going to melt away, rot. If you're bartering things that were perishable, it wouldn't be a store of value. Money has a store of value. There's two kinds of money. Commodity money, which takes the form of a commodity with intrinsic value. Examples here are gold coins. Cigarettes were used as currency in POW camps. Cigarettes are used as currency in current jail situations. And then that's based on a commodity, backed by gold. Gold coins themselves are worth something. It can be melted down. They have value based on the commodity they're made out of. Now, fiat money is money without intrinsic value. It's not based on anything commodity that's valuable. It has intrinsic value. It does not have intrinsic value, I should say. It's used as money because of government decree. It's backed by, say, the United States of America, which the U.S. dollar is. Intrinsic value means that the commodity would have value even if it weren't used as money. So if gold has value even if it wasn't a gold coin. In the film The Shawshank Redemption, prisoners use cigarettes as money, as an example. If you've seen that movie, if you haven't, you really need to expand your horizons and see it. Fiat money is worthless except as money. So if it wasn't money, it's just paper. It's not worth anything. Yet people are happy to accept your dollars or euros or yen or whatever, wherever you are, because they know that you will be able to spend the currency. Okay, it's something that has a store of value. It's based on fiat. It's backed by the U.S. government, for example. Now, the money supply. Remember, money is just a medium of exchange. There's more of it out there. It's less scarce. It can be less valuable. All right, so there's a money supply or money stock. It's the number of dollars. The money supply or money stock is the quantity of money available in the economy. What assets should be considered part of the money supply? Well, there are two candidates. First, there's currency. The paper bills and coins in the hands of the non-banking public, okay, the currency that's in circulation, not in the bank. Then there's demand deposits, the balances in bank accounts that depositors can access on demand by writing a check. Technically, they're not in circulation, but they're demand deposits. The definition of currency in the textbooks does not include the phrase non-bank. I added it here to avoid confusion later. So when you're asked to think about what happens to the money supply when a consumer decides to deposit a $50 bill into his or her checking account, you can think about it that way. Is it currency or is it a demand deposit at that point? Now, there's a few measures of the U.S. money supply. This source is the Federal Reserve Board of Governors. There's M1 and M2. M1 is currency, demand deposits, traveler's checks, and other checkable deposits. Those are things in circulation. M1, as of September 2013, was $2.6 trillion. Okay. M2 is everything in M1, so everything we just talked about, plus savings deposits, small time deposits, money market mutual funds, and a few other minor categories. As of September 1, or as of September 2013, again including M1, so M2 is M1 plus M2, is $10.8 trillion. The distinction between M1 and M2 will often not matter when we talk about quote unquote the money supply in this course. So don't read too much into it. It's just you have an M1 and you have an M2. It's different categorizations. Much more importantly are central banks and monetary policy. A central bank is an institution that oversees the banking system and regulates the money supply. In the U.S., we're talking about the Federal Reserve, which is the central bank of the United States. Now, monetary policy is the setting of the money supply by policymakers in the central bank. And again, the central bank in the U.S. is the Federal Reserve, many times referred to as the Fed. Now, here's the structure of the Fed. The Federal Reserve System consists of the Board of Governors, which is 7 members located in Washington, D.C., and 12 regional Fed banks located all around the U.S. The Federal Open Market Committee, which is the FOMC, includes the Board of Governors and the presidents of some of the regional federal banks, Fed banks, I should say. The FOMC decides on monetary policy, so they make decisions on that. So it has the Board of Governors, the 7 members up in Washington, D.C., and then a select membership from the 12 Fed banks across the country. One permanent member on the FOMC, and actually also on the Board of Governors, if I remember correctly, is the regional bank representative from New York City, because that is the financial hub of the United States and really for a large part of the world up around Wall Street. Now, in subsequent chapters, including the chapter immediately following this one, we will learn that the Federal Reserve's monetary policy can have huge effects on the macroeconomic variables like inflation, interest rates, unemployment, and even stock prices, indexes, and exchange rates. Now, in this chapter, we're learning what all these things mean, so we're setting the foundation for monetary policy here. We'll talk more about the implications of monetary policy in the next chapter. So what are bank reserves? In a fractional reserve banking system, banks keep a fraction of deposits as reserves and use the rest to make loans. That's how banks make their money. They loan out the money that comes in and charge those folks, those investors, an interest rate, and it's higher than the interest rate they're paying the people who are saving there, and they keep the difference. But in a fractional reserve banking system, they're required to hold some of that money back, those deposits back, as reserves. Now, the Fed establishes the reserve requirements, which are regulations on the minimum amount of reserves that banks must hold against deposits, what they need to keep in the vault, what they can't loan out. Banks may hold more than the minimum amount if they choose. Not a lot of them do it because, it's loanable funds. If you got a good loan you can get a return on, you send it out. But you are required to have a certain reserve on hand. Now, the reserve ratio, abbreviated here as capital R, here and moving forward, it equals the fraction of deposits that banks hold as reserves. So it can also equal the total reserves as a percentage of total deposits. Now, segue from the last slide. The Fed controls the money supply and regulates banks. Banks clearly play an important role in the money supply because bank deposits are a part of the money supply. Now, recall that M1 includes checking account deposits and M2 includes savings accounts deposits. So when you're moved from M1 to M2, you're really just talking about liquidity. Obviously, you can get to your money a little easier in a checking account. That's M1. It's a little more liquid. And then M2 is in a savings account. Sometimes you have to wait until it matures to get it without penalty, so it's a little less liquid. So M1 is more liquid, and M2 is less liquid. Liquid means how easily can you get a hold of it to spend it. Now, in the interest of just parsimony here, I have combined the definitions of fractional reserve banking system and reserves as shown in the first bullet point here. I believe it's sufficient to convey the meaning of both terms here. So, fractional reserve banking system implies that there's some sort of reserve requirement, so banks have to keep some reserves on hand. So that sort of goes hand in hand there. Excuse me. Now, a bank T account. T account is a simplified accounting statement that shows a bank's assets and liabilities. For example, let's look at a fictitious First National Bank. Here are their assets on the left here. They have reserves of $10 and they've made loans out to the public, to their customers, of $90. That's the assets they have. They have the rights to that loan. They can call the note on it. They have money coming in every month on that loan. They're earning interest on that loan. And then, of course, the reserve requirements, they're holding back $10. Okay? Very simplified example here. Now, their liabilities are $100. Okay? People have made $100 worth of deposits. They've kept 10 in the vault and loaned out 90 of it. Okay? That's their simplified accounting statement, their T account. Okay, got 100 on this side, got 100 on that side. They're holding $10 back in reserves. They've loaned out 90 of it. They have a liability. The depositors have put $100 in there, so they're liable for that $100 should everyone come in and want it. Now, banks' liabilities include deposits. They include loans and reserves. Now, in this example, we can notice that R, okay, remember R is our reserve ratio. R, in this example, equals the $10 reserves divided by their total liabilities, and so they have a 10% reserve on hand. The deposits are liabilities to the bank because they represent the depositor's claim on the bank. Okay, it's the depositor's money. The bank owes it to them. And loans are an asset because the bank can make because they can they can represent the bank's claims on bars. Okay, they can call the note on those. Reserves are an asset because they are funds that are available to the bank. In this example, let's say the reserve requirement was $10. Well, it's 10% reserve requirement ratio. Now, suppose $100 of currency is in circulation. To determine the bank's impact on the money supply, we calculate the money supply in three different cases. One, if there's no banking system. Two, if there's a 100% reserve banking system, the bank holds 100% of the deposits as reserves and makes no loans. Bank wouldn't make any money just holding on to money like that, not able to loan it out. And then third, there's a fractional reserve banking system. So we're looking if there was no bank, if there was no ability to make loans, and then lastly, and much more realistically, if there's a fractional reserve banking system. Now, case one, with no banking system, the public holds $100 in currency. The money supply is $100. Okay, there's no banking system. It's just $100 floating around between people out there. Case two, 100% reserve. Okay, public deposits $100 in our fictitious First National Bank, FNB. That bank holds 100% of the deposits as reserves. The money supply is the currency plus deposits. Well, the currency is zero. The deposits is $100 because the bank has every bit of it in its vault. The money supply is $100. In a 100% reserve banking system, banks do not affect the size of the money supply. They're just a piggy bank. Now, case three, fractional reserve banking system. Take a look at this. Suppose the reserve requirement is 10%. First National Bank loans out all but 10% of the deposit. They keep $10 on hand as an asset in reserves, and they loan out $90. Okay. Now, their liabilities obviously is the entire $100 they've had deposited there. Depositors have $100 in deposits. Borrowers have $90 in currency. So the money supply is the currency plus the deposits, which is that $90 that they've loaned out, plus the $100 in liability. Okay. Now, that equals $190. The notion that banks create money, this is our first kind of abstract thing that you might have to wrap your mind around. The notion that banks create money by making loans is new and perhaps awkward idea for you. The following slide may help, though. Just keep in mind, though, these depositors in their mind say, well, my $100 is in the bank. Well, the bank says, well, we're only required to keep $10 on hand, so we're going to loan out 90 more. To the depositors, their money's in the bank. To the borrowers, they got $90 new. So you got the depositors thinking, hey, I got $100 in the bank. You got the bank loaning out 90 of it, and the borrowers thinking, well, hot dog, I got 90 new bucks to invest in my business and make more money. Theoretically, you just created 90 more dollars. So the money supply goes from 100 to 190. In theory, now, there's some overlap here. Obviously, 90 of this dollars belongs to the liability folks over here in their deposits. But the depositors are happy keeping that money in the bank, collecting interest, and the investors are happy to take out the loans, paying interest on that back to the bank to invest in, say, their businesses and create growth opportunities. Now, hopefully this will help. Under the case 3 fractional reserve banking system, how did the money supply suddenly grow? I mean, technically it's still just $100, but we grew it under the fractional reserve banking system. Well, when banks make loans, they create money. The borrower gets $90 in currency, an asset counted in the money supply, so there's money out there being spent through investors, and $90 in new debt, a liability that does not have an offsetting effect on the money supply. Thus, the fractional reserve banking system creates money but not wealth. What you're thinking of as that $100 is wealth. It does technically kind of grease the wheels and allow the investors to have that $90 while the depositor is thinking, hey man, I got my $100 back in the bank. So theoretically, grease the wheels a little bit. We got growth going on. We got investment going on. The bank essentially created $90. Now, hopefully you can more easily accept the idea of banks creating money when you see that banks do not create wealth. That little alarm that's going off in your head is that, no, it's still $100 overall. Well, that's wealth. That's the amount of wealth in the system. The bank has just facilitated the ability to have $90 more spending with the reassurance in the minds of the depositors that the deposits are backed, say, by the FDIC. So if the bank went under, the government's going to support it anyway. But they know they're earning money on that deposit, so they're not really, wanting to take that money out. So it allows the bank to reassure them that they're earning deposits while they earn interest on the loans, while the investors take the loans that they've borrowed, the funds that they've borrowed, and invest it back in their business. So all leads to production and growth, which increases GDP, which increases incomes, increases growth in the economy, and makes things better off overall. Now, borrower deposits $90 at the Second National Bank, so it looks like we're moving on from the First National Bank to the Second National Bank. Initially, Second National Bank's T account looks like this. The $90, the 10% reserve, if you remember, is only $9. They're going to loan out then the remaining 81. If the reserve is 10% for Second National Bank, then it will loan out all but 10% of the deposit. So on and so forth. All right. Let's look at the Third National Bank fractional reserve banking system. Okay. Now, let me go back and make something clear. So in the First National Bank, they loaned out $90. Where does that $90 go? Well, it goes into the bank account of the person who borrowed it, right? And then they go spend it. Well, they deposit in the bank account. They're going to then that bank is going to keep 10% on hand. 10% on hand, and then loan out 81. Well, that 81 that's loaned out comes into another bank. See where this is heading? Their reserves is 10%, so they put 810 in reserves and then loan out 7290. It's kind of like a big snowball rolling downhill. Okay. Second National Bank's borrower deposits $81 at the Third National Bank. The initial of the Third National Bank T account looks like this. And then somewhere, somebody's depositing $72.90, and we go on and on and on and on. So if the reserve requirement for Third National Bank is 10%, it will loan out all but 10% of the deposit, and the economy starts growing. Now, the process continues, and the money created with each new loan. So you have original deposit at the First National Bank of $100. They keep $10 on hand, loan out $90. Second National Bank keeps 10% on hand, which is $9, and loans out $81. Second National Bank then, again, is loaning out $81. Third National Bank keeps 10% on hand and then loans out $72.90, so on and so forth. And then we get to a point where we had started with $100 in the total money supply. The effect of the total money supply, if that makes you more comfortable, is $1,000. In this example, $100 of reserves generates $1,000 in money because we have continuous loans. Banks are making money on the interest. The ideal situation is those that are borrowing, invest in their business, and find ways to make new money. And that big old snowball rolling downhill creates new money as it goes and eventually creates new wealth. Okay. Now, originally the wealth here is $100. What we're creating here is an increase in the money supply and momentum through a fractional reserve banking system that we couldn't do if we had no banking system at all, or if we had a banking system that had a 100% reserve requirement. This is called the money multiplier. The money multiplier is the amount of money that the banking system generates with each dollar of reserves. The money multiplier equals 1 divided by that R, the reserve ratio. In our example, R equals 10%. Thus, the money multiplier is 1 divided by R equals 10. Okay? And you just multiply that by that at 100. So the $100 of reserves creates $1,000 in money. Okay? So we could look at it and calculate it all the way out like this, all the way out to where we have no more deposits. Okay, you see it's going from 190, 81, 72, eventually get down here to like the 16th National Bank or whatever it would be, and it would be 0. Okay, and then we add it all up, and hey, our money multiplier was 1,000. Now, you could do that step by step. Let's say here is 16 steps. I'm not sure exactly how many steps it would be. It'd be something like that. Okay. Or you could just know, hey, there's something called a money multiplier. All I have to do is take 1 and divide it by that reserve ratio, okay, that 10%. 1 divided by R is 10%. Money multiplier is 10. So if we start out with $100 in deposits, we know our money multiplier is going to be $1,000 in money. Much easier approach here, right? Okay, you take a choice. You could do it like this, or you could just say, hey, 1 over R. Okay, you just need to know reserve requirement. And you will know the initial deposit times the reserve requirement, and you will create $1,000 in money. Hopefully that helps. Money multiplier is a great shortcut. Now, let's take a look at an active learning activity. The banks and the money supply. While cleaning your apartment, you look under the sofa cushion and find a $50 bill. Yay, and a half-eaten taco. That's what stunk. You deposit the bill into your checking account. Hopefully you don't eat the taco. And the Federal Reserve's requirement is 20% of all deposits. What is the maximum amount that the money supply could increase? What is the minimum amount that the money supply could increase? Interesting. Let's take a look at the first one. You deposit $50 in your checking account. What is the maximum amount that the money supply could increase? If the bank holds no excess reserves, then the money multiplier, 1 divided by R, equals 1 divided by 0.2. Okay, they're holding no excess reserves. They're doing the minimum, okay? The bank says, hey, Fed says we only have to hold 20%. We're only going to hold 20%. Remember, it's 20%, so 0.20, okay? Don't divide 1 by 20. You'll be confused. 1 divided by 20%, 0.2 equals 5. So the maximum possible increase in deposits is 5 times the original 50. Money multiplier is 250. But the money supply also includes currency, which falls by 50. Hence, the maximum increase in money supply is 200. Okay, here's the tricky part. You took that 50 and put it in the bank, the original 50 and put it into the bank, right? So you have to take that back out. Okay, you have to take that back out. So 5 times 50 money multiplier is 250, but when I ask you about the max increase in the money supply, I'm not asking you what the money multiplier is. Here's your money multiplier. I'm asking you, what is the max increase in the money supply? Well, you have to take out the 50 that you put into the bank, right? You took that out of circulation. You put it in the bank. Hence, the max increase is the money multiplier minus the amount you put into the bank. Pardon me. Minus the amount you put into the bank. Okay. Hence, the max increase in money supply is $200. And that's something you're not going to get intuitively. We're going to go through it in class. You got it right here, and then you also need to see it in the reading. Don't let me fool you there. Okay, money multiplier is different from the max increase in money supply because you have to take out the original amount you put into your checking account. Make sense? Okay, good. Now, so you deposit $50 in your checking account. What is the maximum amount you can increase in the money supply? We know money multiplier is 250, but we know we put 50 in the bank, so you have to take that out, so the answer is 200. What is the minimum amount that the money supply can increase? Well, it could be 0. If your bank makes no loans from your deposit, currency falls by 50, and deposits increase by 50, the money supply does not change. Okay, the minimum is always 0. That's a pretty easy one. Low-hanging fruit answer there if I ask you that on the test. So let's take a look at a more realistic balance sheet. Assets. Besides reserves and loans, banks also hold securities. Okay, they own some things that have asset value and securities. They also have liabilities. Besides deposits, banks can also obtain funds from issuing debt and equity. Now let's take a look at bank capital, which is the resources a bank obtains by issuing equity to its owners. Also, you can look at bank assets, if I could speak English today, minus bank liabilities. See, you know what the problem here is? I can't speak. You know that half-eaten taco you found under your couch? Yeah, I saw it and I ate it, and that's why I can't speak English right now. Let's start over. Assets, besides reserves and loans, your T balance here, your T accounts, there's some things other than reserves and loans. Banks also hold securities. They invest in things. Other additional liabilities, so adding to that very basic First National Bank T account. Besides deposits, banks also obtain funds from issuing debt and equity. So they make some money, obviously, their assets, their liabilities based on debt and equity. Now, bank capital are the resources that a bank obtains by issuing equity to its own owners. You can also have bank assets minus the bank liabilities. So there may be a balance there. If you have more assets than you have liabilities, that goes in the bank capital category. You have more capital. And there's leverage also. It's used to borrow funds to supplement existing funds for investment purposes. So a bank can borrow, say, from another bank, or a bank can borrow from the Fed to make an investment itself. This and the next few slides correspond with the section in the text called Bank Capital Leverage in the Financial Crisis through 2008 through 2009, which is an interesting read. So here's a much more realistic assets and liabilities here. You have reserves, you have loans that you sent out, and let's say you have some value in securities you've invested in. Liabilities, you have deposits, okay, of $800. All right, so you're liable for those deposits. You have debt that you've incurred of $150. Perhaps you've invested in something, taken out a loan as a bank. Banks do that. And you also have capital of $50. The leverage ratio is the ratio of assets to bank capital in this example. The leverage ratio the leverage ratio, well, keeps hopping around on me, sorry. The leverage ratio is 1,000 divided by 50, which equals 20. Now, here's an interpretation of that. For every $20 in assets, $1 is from the bank's owners. Okay, $19 is financed with borrowed money. So for every $20 that they have in assets, $1 is from the bank's owners and $19 is financed with borrowed money. Okay, so a bank has borrowed money that they use to finance their leverage ratio. Okay, excuse me. Now, leverage amplifies profits and losses. In our example, suppose bank assets appreciate by 5% from $1,000. 5% increase would be $1,050. This increases the bank's capital from 50 to 100, okay, doubling the owner's equity. Instead, if a bank's assets decrease by 5%, which can happen, bank capital falls from 50 to 0, okay? If bank assets decrease more than 5%, the bank capital is negative and the bank is insolvent. Ruh-roh. Capital requirement, banks can become insolvent. Their businesses as well. Capital requirement is government regulation that specifies the minimum amount of capital intended to ensure banks will be able to pay off depositors and their debts. Okay, so government regulates what the bank can have in terms of capital. So they try to avoid bank insolvency. Now, in the financial crisis from 2008 to 2009, banks suffered some losses on mortgage loans. Remember the housing bubble? People were buying a lot of houses. Prices kept going up and up and up. And banks were happy to keep financing all those houses people were buying. Everybody was investing in real estate. They were happy to be all over it. They were making some crazy loans, right? They were like, it was a very competitive market. They were charging a low price, low interest rate, and doing like ARMs, which is an adjustable rate mortgage. They had crazy low rates for like 5 years, and they shot way up. Well, people got to where they couldn't pay them. When you can't pay the bank can't make money. They're not making money. They quickly become insolvent. So banks suffered losses on these mortgage loans and mortgage-backed securities where they bought investments across a wide range of loans due to widespread defaults. The bubble burst. Okay, people were upside down in homes. They owed $500,000 on homes that were only now all of a sudden worth $250. Things like that. Many banks became insolvent. And in the U.S., 27 banks failed from 2000 to 2007. That's unheard of. Okay, 27 banks in a 7-year span. That's a lot. Well, guess what? In basically like a year and a half from 2008 to 2009, 166 banks went insolvent. That's a big problem. Many other banks found themselves with too little capital. They were in a credit crunch. They reduced lending, and that caused a credit crunch, okay? When you have very little capital, you have a whole lot of money to loan out. When you have banks going insolvent, obviously, you don't have a whole lot of money to loan out. Well, when there's not a whole lot of money being loaned out by a lot of banks across a long time, that's a credit crunch. People cannot get new loans to buy what they need. That slows growth and production, which hurts GDP, which hurts income, which hurts health, so on and so forth. Now, the government's response. To ease the credit crunch, the Federal Reserve and the U.S. Treasury injected hundreds of billions of dollars worth of capital into the banking system as a form of a bailout. Okay. This unusual policy temporarily made U.S. taxpayers part owners in many banks. Interesting, right? The policy succeeded in recapitalizing the banking system and helped restore lending to normal levels. Now, there's a couple ways you could look at this. It was a bailout, right? Okay. There's a lot of companies they deemed too big to fail. A lot of big banks, all right? Had they failed, yes, we'd have a problem. Absolutely. Insolvency, credit crunch like you could not believe, perhaps even financial collapse. So perhaps there's a role for government there to make it better. There are some economists, and I could see the argument, I'm somewhere on the fence on this, that said, well, if you make bad loans, you should be punished by the market. If a business goes out of business because they make bad business, then more efficient businesses will emerge. The problem is, when we had so much consolidation, we had so many banks, say from 2000 to 2007, consolidate, and a lot of banks go insolvent, and then all of a sudden, boom, we had like 166 go insolvent in 1 year. We're running out of banks. So there was a big, big problem there. We had to recapitalize the banks to keep something afloat. Now, the Fed's tools for monetary control, and again, we're going to get a lot more in depth on this in the next chapter, but earlier we learned the money supply is the money multiplier times those bank reserves. The Fed can change the money supply by changing bank reserves or changing the money multiplier. Okay, so they can change, let's say if you had a reserve of 20%, they could lower it to 10%, and then banks could loan out more. That could spawn some growth. They can also change the money multiplier. Now, how the Fed influences reserves are through open market operation, OMOs. That's the purchase or sale of U.S. government bonds by the Fed. Now, remember from previous chapters, a bond is a note of indebtedness, okay? The Fed can sell those. If the Fed buys government bonds from a bank, it pays by depositing new reserves in the bank's account. So it releases money back to the banks. With more reserves, then, more money, the bank can then make more loans, which increases the money supply. So the Fed can manipulate the money supply positively by buying government reserves. They take a non-monetary item, a bond, and they send money to the bank for that item. So they're pumping money into the economy. The banks put that in their reserves. Thus, they can make more loans, which increases the money supply. Now, just the opposite is true if you want to decrease the money supply. To decrease bank reserves, the money supply, the Feds sell government bonds. So banks buy these notes, which are glorified IOUs. It's an investment for the bank. Thus, they make the rate of return on the bonds much more attractive for banks to buy them in instances where they want to sell more government bonds. So if you're selling the bonds, you're pulling in cash as a Federal Reserve. You're pulling in cash out from the market, which reduces reserves, which means banks are going to make less loans. So you can manipulate the money supply in that manner. So the Fed makes loans to banks as well. They can increasing their reserves. The traditional method is adjusting what's called the discount rate. Now, the discount rate is nothing more than the interest rate. So it's an interest rate. But it's the interest rate on loans the Fed makes to banks. So when a bank needs more money, they go to the Feds, and they report to their local area Federal Reserve, whether it's in New York, Atlanta, San Francisco, so on and so forth, Chicago. There are Feds in 12 major cities. And they're regional. So a bank in Georgia would deal with the one in Atlanta, a bank in D.C. would deal with the one in D.C., a bank in New York would deal with the one in New York, and they have all these different regions and territories. This interbank loaning influences the amount of reserves that banks have. It is influenced by banks borrowing. Now, there's a new method called term auction facility. The Fed chooses the quantity of reserves it will loan, and then banks bid against each other for these loans. Thus, it makes a bit of a free market trade on reserves. Okay. The big thing you need to know here is in red. The discount rate is the interest rate on loans that the Fed makes to banks. So the discount rate is the interest rate in which banks loan among themselves. The more banks borrow, the more reserves they have for funding new loans and increasing the money supply. Basically, if they have more reserves, whether it's through loans, whether it's through money creation, whether it's through increased deposits, the more reserves a bank has, the more that they can make loans, okay, and the more investors can spend on their businesses. You just need to make sure that you're making good loans and not on bubble items like the housing market and soon to be the bubble that is educational loans. Stay tuned on that one. We can talk more about it in class. Now, how they can influence the reserve ratio, the Fed that is, recall that the reserve ratio is your reserves divided by your deposits, which inversely affects the money multiplier. Remember how those things were linked as we derived them earlier in this chapter? Rewind if you don't remember, do the reading. The Fed set reserve requirements, remember. Those are the regulations on the minimum amount reserves that must be held against deposits by banks. Reducing the reserve requirements would lower the reserve ratio and increase the money multiplier. It would allow banks to loan more money, and thus that $100 we originally put in, if it goes down from 20 to 10%, that's more money that they can loan out, and thus increasing the money multiplier. Since about September 2008, the Fed has paid interest on reserves banks keep in the accounts at the Fed. So they've kept some money at the Fed themselves. The banks can keep reserves both in their vault and also at the Fed. Raising this interest rate would increase the reserve ratio and lower the money multiplier. Okay, so they have to be careful how they do those rates. You can take money in and out of the economy. The problems with controlling the money supply: if households hold more of their money as currency, banks have fewer reserves and make fewer loans, and the money supply falls. The more money you stuff under your mattress, the less money that's being traded. They have fewer reserves in the bank. They make fewer loans, and the money supply falls. The money multiplier dips too. If banks hold more reserves than required, they make fewer loans and the money supply falls. So if a bank for some reason decides to hold more reserves, perhaps they have a affected expectation that they'll need that money for some reason, a rush on the bank or something like that. That's less loans and the money supply falls. Yet the Fed can compensate for a household and and bank behavior to retain fairly precise control over the money supply. So the Fed, at least in its own mind, can manipulate the money supply, and in technicality, they can take the money supply up and down. Now, philosophically, a lot of people have a question as to whether they should be manipulating the money supply or should the free market be doing it. That's an ongoing debate. Now, here's the thing. What about a bank run? Okay, bank runs in the money supply. A run on banks. When people suspect their banks are in trouble, they may run to the bank to withdraw their funds, holding more currency and less deposits. Under fractional reserve banking, banks don't always have enough reserves to pay off all their depositors at once. Hence, banks may have to close. Think about that bank that had $100 coming in, First National Bank. Well, they loaned out 90 of it. If everybody showed up at the same time wanting their $100, they've got a problem. They only have 10 on hand because it was 10% reserve. Banks in that situation would just close their doors and say, listen, we don't have that all $100. We're going to close. Not permanently. You're closing for the day until they can get that, perhaps a week, perhaps a month, until they can get all that money back that all the depositors want at once. Also, banks may make fewer loans and hold reserves to satisfy depositors. So if they feel like, again, economics is half psychological, and in psychology, we have a thing called expectations. So if you expect there to be a bank run, the bank's not going to loan as much money. If they don't loan as much money, there's not as much money to invest, and we're not growing. So expectations can affect your growth rate. These events increase R, which is the reserve ratio, and reverse the process of money creation, causing money supply to fall. There's less money in circulation. Now, during 1929 to 1933, a wave of bank runs and bank closings caused the money supply to fall by 28%. Many economists believe this contributed to the severity of the Great Depression. It certainly didn't help. Since then, federal deposit insurance has helped prevent bank runs in the U.S. Okay, FDIC means the government is guaranteeing your deposits at a bank. You may not be able to go in there and get it all at once, but the FDIC assures you that the money will be there. They guarantee it to you. In the UK, though, Northern Rock Bank experienced a classic bank run in 2007 and was eventually taken over by the British government. Interesting. Now, the federal funds rate on any given day, banks with insufficient reserves can borrow from banks with excess reserves. So banks can borrow among themselves. The interest rate on these loans are called federal funds rate. Now remember, the discount rate was the rate that banks that borrowed from the Fed, that was the interest rate they paid there. The interest rate on bank-to-bank loans, so say a bank has a run but the bank down the street does not, they can borrow funds from the bank down the street, and the price of that borrowing will be the interest rate on those loans is the federal funds rate. The FOMC uses the OMOs to target the Fed funds rate. Okay. Changes in the Fed funds rate causes changes in the other rates and have a big impact on the economy. They trickle down. The Feds change how you can use open market operations. How the two banks can trade amongst themselves in terms of loans. That will change all the other rates that they charge, say for their what depositors get and also what borrowers get. If they go up, they're all going up. If they go down, they're all going down. It can have a big impact on the economy in terms of whether people are saving or borrowing. Here are the federal funds rates and other rates from 1970 to 2013. You can obviously see some movement here in the 1980s. The prime rate, which is the rate banks charge on loans to their best customers. Again, the prime rate, this is something that's in reading. You need to know. Prime rate is the rate that banks charge on loans to their best customers. And the 3-month T-bill, Treasury bill rate are very highly correlated with the federal funds rate. They tend to chase one another. You can see the same overall pattern here. The mortgage rate shown here is a 30-year fixed rate. It's less correlated with the federal funds rate, but that is to be expected. Federal funds rates, Fed funds, are overnight loans between banks, while mortgages are 30-year loans with consumers. So obviously the bank-to-bank loan process moves a lot quicker than it does the bank-to-consumer process. Just good to know, just to see how they correlate. Now, move this out of the way. Out of the way. To raise federal Fed funds, to raise the federal Fed funds rate, the Fed sells government bonds through open market operations. This removes the reserves from the banking system and reduces the supply of federal funds and causes the R to rise. Okay, so here your federal funds rate, it goes from 1.5 to 1.7. There's a decrease in supply. We know the price is going up, so the federal funds rate, the trading between banks, the cost, the interest rate is going up. Okay, and then the quantity of funds is going down from F1 to F2. So this graph is not in the textbook, so it's not supported with the material in the study guide or even in the test bank. So this is not something you're going to see again on the test. I just thought it would be interesting to graph it. Really, I could have omitted this slide from my presentation if I wanted to, but I really wanted to keep it. It uses a simple supply and demand diagram to illustrate something described verbally in the text, how the Federal Reserve targets the federal funds rate. So it's simple supply and demand, man. The demand for federal funds comes from the banks that find themselves with insufficient reserves. Okay, so they need to borrow some money from the Fed. Perhaps they made too many loans or had higher than expected withdrawals, maybe a little bit of a run on the bank. The supply of federal funds comes from the banks that find themselves with more reserves than what they want, perhaps because they had a lower than expected withdrawals and because fewer customers took out loans. So they have money to loan to other banks and make a little money like that as an investment. The federal funds rates adjust to balance the supply and demand of the federal funds. The Federal Reserve can use OMOs to target the federal funds rate. Whenever the rate starts to fall below the Fed's target, the Fed sells government bonds in the open market in order to pull reserves out of the banking system. This raises the rate as shown in the diagram, going from 1.5 to 1.7. If that rate raises above the Fed's target, the Fed will buy government bonds in the open market, injecting reserves into the banking system and thus pushing the rate down. Basically, they oil the wheels in this situation. You see the money supply is actually going down. The Fed's going to respond by buying government bonds out there and injecting some cash into the economy to make the supply go back out. Rates are going to go back down. The funds are going to go up, and spending will be higher. For the Fed, OMOs are quick, easy, and effective, so the Fed can keep the Fed rates very close to target. So they can manipulate by buying and selling government bonds and thus influencing discount rates and the federal rates charged between banks for loaning to one another. Basically, they want to make spending easy. Problem is here of late in our country, we've made going into debt easy, which is a real problem, which hurts investment. So the whole point of the Fed is to protect the value of the dollar, and we haven't done a great job of that. But one thing the Fed does pride itself on is making sure there's loans out there or funds out there to make loans, because if you're making loans, you're making investments. People are making investments in their business. Hopefully they're growing and become more productive. You're growing and become more productive. Your GDP is going up. Your production is going up. Your incomes are going up. Your health care is going to get better. Your education is going to get better, and your crime rate is going to go down. All good things for the economy. Now, some people will argue that the market could do this on its own, okay? The supply could adjust because if you're getting a higher rate, more banks are going to be willing to loan funds to other banks. Okay, so eventually it would work its way out to supply increasing. We do that quite manually in this country with the central bank. All right, now, it's up for debate as to whether or not that's the right thing to do. Personally, I think the free market could adjust quite well. Some people don't see it that way. So it's one of those things that even the brightest economists argue about to this day. So it's an ongoing debate. So, not to drag you into that debate, let's talk about a summary of the chapter. Money serves three functions, and these are things you're going to need to know. Money serves three functions. Medium of exchange, okay, it's a unit of account, it's a store of value. There are two types of money. Money based on commodity, okay, that has intrinsic value, and fiat money, which does not have intrinsic value, but it's backed by things like the U.S. government. The U.S. uses fiat money, which includes currency and various types of banks deposits. Remember we talked about M1 and M2. In the fractional reserve banking system, banks create money when they make loans. Bank reserves have the multiplier effect on the money supply. We start with 100, we end up having a multiplier effect of 10. 1 times 10 equals $1,000 in the money supply. That was pretty neat how we did that, right? Because banks are highly leveraged, a small change in the value of banks' assets causes a large change in bank capital. To protect depositors from bank insolvency, regulators impose minimum capital requirements. You can't be overly leveraged. You got to have a certain amount in reserves, and you got to have a certain amount of capital on hand. The Federal Reserve is the central bank of the United States. The Fed is responsible for regulating the monetary system. The Fed controls the money supply mainly through open market operations. Okay. Purchasing government bonds increases the money supply. Purchasing bonds, you're buying the bonds, sending the cash out into the economy. Selling bonds decreases it. By selling bonds, you're taking cash out and giving out pieces of paper that say they're indebted. So you're taking money out of the economy, so you decrease the money supply. In recent years, the Fed has set monetary policy by choosing a target for the federal funds rate, the rate at which banks loan to one another. Okay, pretty straightforward chapter. A lot of stuff is going to be new to you. You got to make sure you're doing the reading if you're going to be able to nail it on the test, okay? As always, if you have any questions, feel free to stop by, send me an email, give me a call. I'll be happy to discuss these with you. We will get much more in depth into the impact of monetary policy in the next chapter, so look forward to that. Thank you so much.